Well, I think that the Fed, it's an independent agency, and our job is to comment on how the economy is doing. And, I think that the Fed made a move yesterday that markets have responded a lot to. I think as I've watched the discussion today about what the Fed did and how it's impacting markets, I've seen some confusion that I just wanted to clarify, because I think people are getting their economic models wrong a lot in response. Yeah. So the basic idea is that when the yield curve gets flat or inverts, then that historically has shown you that the risk of recession is higher. But that whole literature that looks at yield curves looks at a time when there's no quantitative easing. And so if we were to remove all the quantitative easing all around the world, then the 10-year rate right now would be, according to the Fed, about 100 basis points higher. If it was 100 basis points higher, which is consistent with the 3% growth we're seeing, then of course the yield curve wouldn't even be close to inverted. And so that old literature is not useful right now as a guide to what the recession risks are next year, because the end of the yield curve is being pushed down by QE.
That's fair,
so,
but Kevin,
yeah.
There are a lot of other market signals right now that are flashing warning signs about the economy. Oil prices, for instance, in the last 3 months are down 34%. The NASDAQ is now down about 20% from its recent high. The S&P down 16%. So what's that telling you about the economy?
Right. Well, the oil price decline is clearly related to the fact that Asian economies are weak and the European economy is weak. But, right now, GDP now is at 2.9 in the fourth quarter. Last year at this time, I used to come on CNBC last year and say we were going to have 3% growth this year. And a lot of your other guests said we were crazy. Well, it looks like we're going to have 3% growth. And so the fundamentals for the U.S. economy are very strong right now. And you're absolutely right. There's some financial market gyrations, but I think that they're related in part to this global slowdown, and in part, I think, maybe to a confusion about this yield curve and what it means, because QE is affecting the end of the yield curve, and that has a big effect on the way you should interpret that literature that says that recession risks are higher.
That's fine. Granted, Kevin, maybe we have to make some adjustments to our interpretation of the yield curve right now, but clearly the markets more broadly are bracing for some magnitude of slowdown in the U.S. economy next year, not strictly because of global weakness as well, right? You have tariffs in there that are interrupting the whole picture in terms of what we can expect next year, downgrades of earnings. We had Federal Express kind of warning on this stuff. So do you think that we are going to have a meaningful downshift in the U.S. economy next year? And is that why the administration has been critical of the Fed at this posture?
Well, look, I mean, on the first part of the question, again, last year at this time, I forecast that this year would be 3.1. And it was based on the fact that capital spending would go up after the tax cuts. If we get about 2.5 in the fourth quarter, which is below the GDP Now estimate right now, then we get the 3.1 that we said. And so I don't really see any reason why I should adjust my forecast of about 3 for next year, given that this year came in as exactly as expected. And so the fact is that capital spending has surged a lot. It slowed a little bit in the latest data, but in part because the guys who produce capital goods are at capacity and having a hard time meeting the high demand. And so that's usually a very favorable signal going forward for the economy. And so I think the odds of getting a GDP growth number next year below 2 are very, very small, given the momentum we're carrying into the year.